Hello, everyone. I'm Vic Kruger, and welcome to the MMP Fall 2021 Agricultural Industry Webinar. In our spring webinar, vaccinations were just starting, and we thought that we were going to get back to normal. Then the fourth wave happened. With COVID numbers again now declining, we can only hope that we have finally seen the end of the high case numbers so that we can enjoy the holidays that are coming up with our friends and family. I am a Senior Vice President of MMP Ltd, the insolvency and restructuring arm of MMP LLP. MMP LLP is one of Canada's largest professional services firm with offices across the country. We have specialized client services groups that we call niches, each with dedicated employees working in the niche. This allows us to be able to provide our clients and the industry with knowledgeable practitioners. We have identified 16 specific business niches, with agriculture as our largest and oldest niche that dates back to 1958 when the firm was established. As the agriculture niche is so large, it is further broken down into sub-niches, including food and manufacturing, intensive livestock, primary producers, Hutterites, and farm income programs. MMP is also the only professional services firm with a farm management consulting group comprised of professional agrologists and consultants who come from extensive agriculture farming backgrounds and bring a high level of technical expertise, firsthand knowledge, and close relationships with the agriculture industry to give us a real understanding of the issues faced by today's agriculture industry. The FMC group supports all of our other service lines, and in any ag-related engagement involving the restructuring of an entity, they get involved and provide us with expert advice to the specific situation, and if necessary, to become hands-on in a formal engagement. Our presenter today is from, again, the FMC group, John Lepke, who is located in our Winnipeg office. John is a professional agrologist who has approximately 20 years experience providing services to the agriculture industry, starting as an ag lender and then as a consultant to the industry. John grew up on a mixed grain and hog farm in southeastern Manitoba and still lends a hand on the farm as needed. Our webinar, again, has been pre-recorded to allow you to watch it on your time. At the end of the presentation, you will find contact information for both John and me for any questions you may have. We will then respond to your questions as quickly as we can after this session. John, the floor is yours.
Thanks so much, Vic, and welcome everyone to today's session on sort of the ag industry outlook for fall of 2021. So here's a little table of contents just on the agenda, what we're going to run through today. We'll start off talking some market fundamentals. We'll look at briefly a little bit of US dollar information, and then we'll kind of look at each of the different sectors as we go through them and see what kind of is affecting them today and what might be affecting them in the future. So to start off with, we'll start talking a little bit market fundamentals. You know, obviously in agriculture, we're looking at the commodity markets and commodities in general. And so we have to start off probably talking about supply demand and just the relationship those two have together. You know, for the most part, Canadian ag commodities, we're talking about being a net exporter. You know, we produce way more than what domestically we consume in Canada. So we really sometimes focus on the global economy and why that's important, because it does affect you know, Canadian farmers either from input costs or you know, whatever they're selling their commodities at, you know, pricing. All those things are affected from that standpoint. You know, we've talked to some industries in the past where they're like, well, you know, if we'd only get Canadian consumers to buy more of our product, that would solve maybe a low price And when we really dig into it, what we find is there's, Canadian farmers just supply way too much for the domestic consumer to have any sort of measurable impact. So we really do need to look at on a global scale, right? Supply demand, and sometimes just because, for example, we're having a poor Canadian grain crop, that doesn't mean the rest of the world is experiencing the same. So locally, we might think that prices should be higher because, demand is low. But when you look at the rest of the global economy, we have other factors in play there. So, and the other thing, we talk about, obviously, since we're exporting so much of our product is trade. Trade is, hugely important to Canadian farmers, and some of the trade negotiations that our government gets involved in really do have a huge impact on farmers across Canada. So we always do like to update you on kind of what trade negotiations are happening, or some of the impacts of past trade negotiations. So given the last couple of months and I guess year and a half during COVID, we definitely have seen less trade happening as far as negotiations and new deals. Pre-COVID, there was a flurry of different trade, I guess, negotiations that happened that had some big impacts on Canadian farmers, and we'll talk about those as we kind of go through each of the individual sectors. Obviously, couldn't have a discussion around ag today without talking about supply chain disruptions. It's impacting people's personal lives and definitely impacting agriculture in a big way. So maybe I'll save that topic. We're going to talk a little bit about it in more detail in the future. I guess I'll just make the comment that usually, in agriculture, your lowest cost of production wins. That meaning that, where certain commodities are produced in the world usually gravitate to the lowest cost of production. And part of that is transportation and making sure that there's a cheap, accessible form of transportation to get that good from your wherever it's being produced to wherever it's being ultimately consumed or processed. And so definitely we're seeing some big supply chain disruptions on the transportation side. And like I said, maybe we'll get into that a little bit down the road. And maybe something a little more unique for Canada is supply management. And that's where we really restrict supply on certain commodities to match demand. And so that's obviously more on your dairy and your feather side. So something that, Canada has that maybe when we're looking at the US, they don't have a direct supply management industry like we do. So definitely some different factors at play there, and impact not only, mainly impact the price that farmers get and the environment that they work in. So with that, I think we'll move to the next slide. So I talked a little bit about, monthly exchange or the trade, and I guess we have to talk about the US right now. They are our largest trading partner by far for any ag commodity. And so really we do need to talk about what the exchange rate looks like between, Canadian and US dollars, because not only do we, export lots of product down to the US, a lot of our prices for our commodities are set in US dollars. And so depending on what the foreign exchange is for those rates, directly impacts the price that farmers get in Canada. So you can see over the last year, we've kind of gone from I'll call it a weaker Canadian dollar to a stronger Canadian dollar. And so that definitely is good for anyone importing product into Canada, but for most farmers exporting product out of Canada, not as favorable. So, it'll be interesting to see where the US economy goes, how fast, they recover, what their inflation rates look like versus Canada. All those things have a big impact on kind of the foreign exchange between the two countries. So something to keep in mind, just as we talk through all these different commodities and prices of certain commodities, the dollar definitely impacts where those go. So looking more on the trade side, a little bit of an update there. Canada, China, probably the biggest news recently. The CFO for Huawei returned to China, as part of a deal with US prosecutors. She had been detained on house arrest in Vancouver for quite a while. And interestingly, days after her departure, the two Canadian citizens, the two Michaels, that were I guess brought back to Canada. So interesting how that all played out. There definitely was some big impacts to our canola markets as part of this whole negotiations, and really brought to light, I think what everyone knew, but now maybe solidified it a bit. China gets really political when it comes to trade, and so Canada was on the brunt of that, I guess, recently, and so it'll be interesting just to see how future negotiations are impacted, not only between Canada and China, but other countries. Now that this is a really good example of kind of how politicized China gets with some of its trade deals. So there's obviously still tension between our two countries. Canada definitely is, I'll call it, unsure on its position on China's request to join a recent trade deal, the CPTPP. So lots of concessions were made for Canadian farmers and against Canadian farmers, I guess, as part of that trade deal. And so bringing China into it just magnifies, I guess, some of those trade negotiations. And it magnifies it because just the size of China, right? They're huge. It's larger than all of the other 11 members combined, right? So to bring China into that deal would be a game changer. So interesting to see where that's going to go and what the impacts of that could potentially be. And so, talking a little bit more supply chain side and some of those disruptions, fertilizer prices, I guess, have been through the roof. And, we've seen them hit record highs that we haven't seen for a lot of years, I think probably since 2008. The reasoning behind that, is that there's lots of fertilizer manufacturing plants in the UK that just shut production down due to their extremely high cost, right, which is natural gas. That's their input that they use to make fertilizer. So with a really high natural gas price, there's some plants that just didn't see their way to profitability, so they just shut down. And so that meant that supply of fertilizer was reduced, and obviously that spiked up the prices. So what's the ripple effect of that? Obviously, the big one is for anyone in the crop industry, their input costs just went up significantly. But obviously, anyone that uses those crops for feed, for example, that ripple effect is going to be felt into the livestock market as well. So as you'll see, as we go through some of the other commodities, you're going to see a common theme is that, gross margins are really, we're predicting those are going to be tighter just because fertilizer costs are high, which obviously impacts the crop and the livestock market. So kind of continuing with that theme, we've also seen lots on the freight side. Freight shortages are continuing to disrupt supply chains of all sorts of industries, but ag for sure, right? Definitely some of those key commodities are being impacted. Import terminals are seeing huge increased traffic, and shipping container availability is also extremely low. If you've seen any pictures in the news of, say, San Francisco ports, you've seen cargo ships having to wait, weeks to dock at the terminals, and you're seeing all sorts of container ships lined up one on top of the other in some of these ports. And so with commodity prices already at, near all-time highs, that freight disruption only adds uncertainty to a really tight supply outlook. So, and how extreme is it? When we're looking at the price of shipping containers, historically, to give an example, they were about $2,000 to get a load of freight in a sea can from China to the Western US. And, looking at it today, we're probably closer to 20,000. So huge increase in shipping costs, kind of going both ways that really are, disrupting all sorts of markets. And obviously item availability is at risk. Now that economies are really starting to get back more into a full swing. I wouldn't say we're all the way there, but definitely more ramped up, and especially approaching that holiday season. I don't think we're going to see shipping, woes go away anytime soon. If anything, they're going to get worse before they get better. So moving on to poultry, in general, I think we'd say the outlook for poultry is probably for growth going forward. During COVID, we definitely saw the demand for poultry products going down slightly, and so I think we're seeing that coming back up now. And it's a mix of we'll talk about it later, but I think restaurants are starting to open back up, and people are getting back into, I'll call it, a little more normal routine in life. And so part of that is demand for all the poultry products, right? Chicken, eggs, turkeys seem to be going up. So again, profitability, I think margins are going to be looking better going forward in 2022, but definitely rising feed costs, right, are going to be probably the number one thing that's impacting profitability for the industry. So that's probably the one thing to look out for, probably the most. And then there's some trade deal compensation that's probably been a little more solidified that's come through, and we'll maybe talk about that in a slide or two. So just kind of circling back to demand, we've seen it definitely recover over the last 2 quarters. And as I mentioned, restaurant traffic has probably been the main driver of that. We did have a little bit of imbalance between demand and supply there for a while during COVID, but we're really seeing that sort of stabilize a lot more now in Q4. Part of it is that the industry has to always look forward and predict where demand is going to be, and they don't always get it right. So especially during an unprecedented time like COVID. So as we kind of get back to more normal life, it gets a little easier to start forecasting where that demand's going to be, and then matching the supply to that. So probably a popular food was chicken wings, and those prices were extremely high, kind of as part of that. But we're starting to see those kind of at least remaining flat over Q3 and into Q4. So the good news for the industry, though, like chicken still remains the #1 meat consumed in Canada. So I don't see that changing anytime soon. So definitely it's good news for the industry from that standpoint. So if we're looking at trade compensation, this is in relation to the CPTPP trade deal that I mentioned earlier. If we let China in on that one, could have a even bigger impact on Canada. But the dairy farmers already had their compensation program kind of come out a while ago. The poultry and the egg side of thing just started coming out with a little more formalized product here, or program, sorry. So the intent obviously is to compensate farmers for the market share given up during that CPTPP trade deal, and also to boost competitiveness in an industry where it is already very competitive, right? So the big number is there's $647 million over 10 years for chicken, turkey, egg, broiler hatching egg. Those are the industries that are being compensated. So how are they actually doing this? They are doing it by by assisting farmers in funding different projects, right? And these projects are supposed to increase efficiency or productivity on their farm. The project can respond to some sort of consumer preference, like organic eggs or something like that. And the other project they're looking at is improving on-farm safety, biosecurity, or environmental sustainability. So the program, I think, is on for about 10 years. So farmers have a long time to access the money. It's definitely not on a first come, first served basis. It's based on your quota holdings. So that being said, good news for the industry that they're being compensated for some trade deals that Canada made to give up some of their industry. So, or sorry, part of their market share. So the Kuzma deal, I don't think will have as big an impact, but remains to be seen exactly how the government might land up compensating poultry farmers for that one. So moving on to dairy, I think we're really seeing demand sort of shifting, and I'll get to that in one or two extra slides here. And as again, similar to the poultry, as consumers kind of change their habits, as their life changes, the industry tries to shift with that. So obviously the feed costs are going right along, same as the poultry side, really squeezing margins from that standpoint. So it will be interesting to see how farmers sort of deal with that, what they can do to counteract that, how they can maintain a good product, but still maybe look at alternative feeds out there that they can use. So and then I'll also talk a little bit about the price of dairy and the price at the farm gate, the price that farmers get. I'm sure you've seen in the news maybe that they've announced the annual increase. And so I'll go into a little bit of how that gets calculated and what that might mean for margins for dairy farms going forward. So maybe, just looking at demand for dairy products, you can see, if we look at the year ending, February 2021, we saw that, demand was increasing across the board quite heavily, right, for all the different types of dairy products, milks, creams, butters, cheese, ice cream, yogurts, all were showing really strong signs of positive increases. We fast forward to midsummer and look at, where that was shaken out compared to a year ago. And yeah, we're starting to see it taper off a bit, right? Demand is sort of stabilizing. People aren't looking to increase a lot of milk products in their diets. Although we're seeing still positive increases, right? Just not at the same rate that we were back in February. And likely just speaks to coming back out of COVID to a certain extent, not that we're out of it, but like I already said, restaurants kind of starting to fill back up and a bit more normal consumer behavior, if we want to call it that. So as I mentioned, feed costs are continuing to rise based on grain prices, and we'll get into that when we talk about the grain industry. So we're really seeing purchase feed costs driven by high commodity prices, right? And looking forward into 2022, we don't expect that to change for a while anyways. Definitely the first half of 2022, we think we're still going to be seeing those high feed prices for dairy farmers. The other thing is obviously they do grow a lot of homegrown feed for dairy. All your silages and your hay and your alfalfas, those costs are going up too, just by virtue of higher fertilizer, higher fuel, higher labor costs. So those costs are all on the upward trend, I guess, if we want to call it that, and we don't see those coming back down anytime soon. So how the supply management system works is that they do try and compensate, in this case, dairy farmers for their cost of production, so they can at least maintain a margin. And so kind of what we've been seeing over the last couple of years is, definitely those price increases that dairy farmers are getting for their milk products aren't keeping up with their actual cost increases. So what that means, obviously, is margins are getting compressed. It's happening in dairy. Obviously, it's happening in all the ag commodities. So dairy has not been spared that. So if we want to talk a little bit about just kind of how these milk prices are set for the farmers, it really is broken down into two categories. The CDC, the Canadian Dairy Commission, does an annual cost of production study just to identify what does it cost dairy farmers to produce a liter of milk. So 50% of that increase is based off of that, and then the other 50% is based off the consumer pricing index, right? And that's taken right from Stats Canada. So little example. So in 2019, the cost to produce a hectoliter, I guess, of milk was $83.13. And so there's always a time lag we have to be aware of. They do the cost of production study in 2019 for the following year, 2020. And then it usually takes a while for them actually to get that price in place. So it's usually almost a year and a bit time lag. So they do look at the consumer pricing index just to try and normalize that cost of production. So in this case, there was actually deflation. Costs were going down by $1.51 per hectoliter. So that actually meant that the price that farmers were getting actually went down. And for the 2019 year, which actually would have come into effect in, I guess, early 2021. When we look at this year, we see, cost of production went up. Not a big surprise, right? Given all those factors I kind of just talked about. So the farmer's cost went up by at least 2 cents, a little over 2 cents there. But then when we look at inflation, right, that consumer pricing index swung hard the other way. And so that's a big chunk of why the support price for milk has gone up so much, is just that inflationary pressure that's impacting all the different areas of cost for a dairy farmer. So hopefully that gives you a little insight on how milk prices are set, and I'll kind of say, they're set in that prices don't go up either, right? So not only do they not go down, but they also don't go up. So there's two sides to that coin, I guess, for dairy farmers. And just an interesting note, this is from Manitoba, kind of showing you what the quota exchange value has been in Manitoba anyways. And so shows multiple years and what the trends have been. And so interesting that even though margins are being compressed over time, we're definitely still seeing farmers bidding more and more for quota and driving that price up. So I'm sure the trends are the same in other provinces. In Manitoba, we're definitely seeing fewer and fewer farms on the dairy side, definitely consolidation happening. And so I would suspect that farms are using their quota that is free and clear and paid for already to help finance new quota that they're purchasing. So speaks to the borrowing power a little bit of dairy farms in that, banks should have some good security, and increases to a certain extent borrowing power for dairy farms, although cash flow is always a big consideration there, not just your security value. So moving on to the grain side, it's kind of been a mixed story, I'll call it that, across Canada, depending on what part of Canada you're in. The 2021 harvest was definitely there was a drought in the western part of Canada, and I'd say probably pretty good growing conditions on the eastern side. So depending on what part of the province, or part of the country you're in, you'll have experienced probably a good harvest or or maybe one that you would like to forget about. We'll also talk about farm equipment at the end there, and go through that. So we're going to start off actually talking about grain production in the U.S. Just because, you know, prices are set in the U.S. for a large part. We export a lot of grain over to the U.S. So what happens in their market definitely is a big impact on ours. So, you know, when we were putting this together, harvest was, you know, ahead of the 5-year average. So that was good for farmers down there. They weren't losing quality because, you know, of what conditions or anything like that. Definitely, we are seeing some big crops come out of the U.S. And I'm sure everyone's going, so yeah, there's big crops in the U.S. How come prices are so high? Well, it's because the rest of the world is experiencing some challenges, I guess, in growing some crops. So when we look at that global economy again, that's kind of what's driving the higher grain prices right now. So, you know, corn, for example, the U.S. produced 14.2 billion bushels in 2020. This year, we're, you know, not us, but I guess industry is forecasting that there's going to be over 15 billion bushels harvested this year. And same for soybeans, right? 4.2 billion in last year and bumping that up to 4.4 this year. And based on, you know, yields, right? Not necessarily based on more acres. So, and corn and beans are kind of your two big grain crops produced in the U.S. So that's a little bit where we focus. Moving on to look at what's happened in Canada, you know, I think we had the majority of grain producing areas had pretty good harvest weather. For Western Canada, it was mostly uneventful. You know, in Ontario, I think they had some struggles due to some heavy rains. So again, you know, based on where you were in the country, you probably had were happy with some of your yields or not so much. That being said, you know, if you were in Western Canada and you didn't have great yields, I think you probably had some fairly decent crop prices. And what we saw was a lot of times the price counteracted the loss in yield, and farmers landed up probably with the same top line revenue, even though they might have had, for example, 65% of the normal yield that they had. So, well, the comment, I guess, also is, you know, grain movement has been good. There's been times in the past when the rail system has made it hard to move grain, but definitely we're seeing that there's lots of cars available, and so grain movement has been good. I think that's also a factor of other consumer goods due to COVID maybe not moving. So rail lines had lots of extra capacity to move grain. Yeah, again, you know, yields obviously down in the West due to drought conditions. But I think if we look in the East, corn and winter wheat yields are up. So again, you know, back in October, progress was pretty good on harvest, and everyone wasn't complaining about having to slug it out during a hard harvest this year. So that definitely will keep fuel costs and trucking costs down as a result. So if we're looking at, you know, overall production, you know, StatsCan reports, which is always an estimate, is, you know, a bit smaller soybean production, you know, just under 6 million tons for Canada, which is significantly down from its peak in 17. You know, we saw more seeded acres this year than last year, but, you know, based on that drought, 12% decrease in yields. So we've also seen, you know, some of the smallest canola production in a long time, only just shy of 13 million tons. Big decrease from the peak in 17, and still a big decrease from last year. So largely it was due to decreased yields because we actually did see an 8% increase in seeded acres versus last year. So, and also, you know, we're seeing some of the lowest wheat production for quite a while, 21.7 million tons. Again, that's a 30% decrease from last year. So, and spring wheat is a large part of that. So yeah, the drought definitely had a big impact on grain production in Canada. As I mentioned, though, for a large part, prices made up for it. That being said, I'll just make a note, on the marketing side, lots of guys saw good prices, earlier on in the year and decided to contract or fix those prices earlier in the year and might have missed some of the highs. So going forward, it'll be interesting to see just, the farmer's mentality on, they might have got burnt this last year by contracting, or vice versa, not contracting worked out really well. So what they're going to do this year is going to be interesting to see. And largely it's going to be based on their experience on what happened this year, right? Either positive or negative. So just talking about machinery purchases a little bit, and how come we're talking about this? Typically, what we've seen is it gives you a bit of an insight into how farmers are feeling on the crop side, whether they're optimistic about the future or not. Typically, if they see good margins or the future looks positive, you're going to see guys reinvesting in their equipment. And if the future doesn't look quite as good, you're definitely going to see guys holding back. So again, we're seeing year over year increases on 2-wheel drives, 4-wheel drives, combine sales, everything is up. So, I think probably when the survey was done, crop prices were significantly higher than they have been historically. And maybe some of the high fertilizer prices hadn't been realized yet. So there definitely was a lot of optimism. Guys looking at high commodity prices and factoring in that they were going to have some pretty good margins going forward. So if we take a look at hogs for a second, I think we've seen probably across the board, if I can generalize, some positive margins this year. Hog prices definitely have been up. And so if we're just looking at the price side, definitely good prices, but obviously in the latter part of the year here, they've been compressed. The margins have been compressed by some very high feed costs, right? And adding to that is strengthening Canadian dollar to a certain extent. So I'd say the first half of the year, if you're a hog farmer, you probably were making some pretty decent money. And then in the last half of the year, you're probably starting to see your margins getting squeezed by that high feed cost. So going forward, we can already predict that the feed costs are going to continue. Not quite sure what's going to happen in the latter part of the year. Assuming that prices are kind of stay at this level, I think we should see some positive margins for guys. Again, I think depending on what guys did for forward contracting is going to, obviously have impacted their bottom line to a certain extent. And their experience on forward contracting this year is definitely going to impact their decision on what they're going to do next year. So I'd say the first half of the year, obviously margins getting compressed by high feed costs, and assuming that we can maintain strong prices and hopefully we see some of the feed costs drop off as we get closer to a North American harvest, then we might see some positive or some good margins come back into the industry. So probably should talk a little bit about African swine fever as well. And maybe I'll save that for a couple of slides. So just, a little sidebar on hog production in the US. We've seen slaughter capacities going up, which is good for the industry. And so, 2018, it was just under 500,000 head per day. 2020, we saw it jumping over that as some of the new plants came online. But obviously COVID had an impact and still has an impact on some of these plants, right? So some of the closures that happened during COVID, we're still seeing some of those big backlogs happening as a result. from that. And if we just look at the overall industry in the US, you know, their hog inventories are about 75 million head in September. And so that's about a 4% decrease from a year ago. And so definitely COVID had a large part to play with that. And so I think the industry is starting to rebuild, but to a certain extent, when those plants go down, this is one of the ripple effects that we see is guys just don't have a home for their pigs, so they stop producing to a certain extent. So just talking about African swine fever, you know, it's been identified in the Dominican and Haiti. And so, I mean, that's pretty far ways away from Canada. So why are we concerned about it? Well, the issue, because the Canadian and the American market are so linked, it really is a North American market. And so if all of a sudden the ASF spreads into Puerto Rico, it's a US territory. And if you follow kind of that line of thinking, then all of a sudden all of the US will get tainted by that, and we'll be having to deal with, you know, ASF in quote unquote the US, even though it's not technically in the major parts, right? So, you know, USDA and customs are, you know, they're already ramping up and taking a lot of precautionary measures just to try and stop that virus spread. So, but obviously, yeah, the main focus is trying to prevent that spread to the mainland US. If that happens, then all of a sudden, you know, the US likely will have to stop exporting to most of the countries around the world. And given that a lot of Canadian hogs go down to the US, there's that whole ripple effect, how it comes back to Canada. So, so if the US gets shut down from exporting, then basically Canadians have lost a huge market for their hogs, and that ripple effect is going to come back to us in Canada. So looking at cow-calf, you know, on that same theme, obviously there was a drought in the Western provinces, and we did see, you know, some herd dispersals as a result of that. You know, guys just didn't have the feed on hand to feed their animals. So for various reasons, you know, they just dispersed herds. So we did see some sales like that over this last year. And yeah, obviously, you know, the quote unquote fall calf run started a lot earlier. And we saw increases in July and August as guys kind of predicted that they weren't going to have enough feed to actually finish out animals into the fall like they normally do. So through that, and again, you know, in Western Canada, we did see some support programs to assist you know, farmers to go out and buy feed and also to transport feed to animals. And so this impacted obviously the beef sector, and we saw it ripple over into the dairy side as well. So definitely, you know, the government recognized it was a widespread issue and brought in place some support programs to help farmers go out and buy feed and the associated costs of transporting that feed to their animals. On the beef side, I know in Manitoba anyways, they also had a program to transport animals to feed rather than bringing the feed to the animals. So just a glimpse kind of, you know, if we're looking at Alberta, what that 500 to 600 pound steer price was. Again, showing your 5, 10 year averages layered in with your last year and where we're at this year. So definitely the prices haven't, you know, trending well above the 5 and the 10 year averages. So that hasn't been the issue, is the price. But again, anyone having to buy in feed, you know, that's obviously going to impact your bottom line because you're rising cost of production. So if we look at feedlots, over the years, we've kind of seen Canada switching from a net exporter of cattle to actually now an importer of cattle. So again, the Canada and the US market are so intertwined. depending on exchange rate, cost of feed, a bunch of those different factors. You'll see, kind of Canada being an exporter or an importer of cattle in general. One thing that may impact the industry going forward here is if all of a sudden Cargill does have a plant closure, and specifically that one in High River. I think strike notice has been given already, and in early December, we'll find out if they actually do go on strike. If all of a sudden that does happen, that'll be a major impact for the Western beef sector, just given how large of a plant Cargill actually is. And, already seeing some good demand for beef. I think beef demand is up in Canada, which is good for the industry. But if all of a sudden, we can't actually get or produce beef, box beef here in Canada, you'll see those prices at the grocery going further higher. And inversely, feedlots won't have anywhere to send their animals. So the price for actual live beef is going to come down. Again, kind of like with all the other livestock, feed prices are definitely pressuring margins. And so even though, the prices are going up, definitely costs are going up right with it, and pressuring those margins. So if we look a little bit just at, like I said, Canada switching from being an importer to an exporter, you can definitely see that as we're going over the years here, highs in 07 area and now coming down to 2021, we're definitely exporting a lot less, and the flip side obviously is the imports, which I haven't shown, but those are trending the other way, right, and leading to us flipping from one to the next. Moving on to wineries. Yeah, they're definitely getting impacted by supply chain issues, like lots of other Canadians are, causing all sorts of delays in shipping. Glass bottles, for example, coming from overseas are obviously at a much higher price and taking a lot longer to get here. So their cost of goods are definitely going up. And, likely I think what we're going to see is those companies needing just to stock more inventory of that nature. And when you start doing that and move away from that just-in-time type delivery, likely that's going to put a little more strain on lines of credit, and potentially you're going to need higher limits for those sorts of things. For BC in particular, it was a bit of a mixed year. They had fire and heat that really reduced yields by about 15 to 30%, but that also increased quality. So kind of a mix there. And obviously now that I'm sure everyone's seen the latest news for the coastal regions, anyways. Yeah, we could see even bigger supply chain issues for some of those located over in the BC area, just as they're dealing with massive floods. So looking at the cannabis industry, retail sales look like they're continuing to increase and changing a bit of a price point, right? Instead of manufacturers chasing sort of a luxury user, they're looking at developing products for all sorts of different price points, and realizing that consumers are going to be buying at some of those different prices. So we also saw continued mergers and acquisitions as the year went on, but when you look at the market, even though it's consolidating, market share still seems to be fairly fragmented. So and yeah, as with everyone else, there's that drive for lower cost of production, right? As that industry really starts to turn into more of a commodity, everyone's really looking at lowering that cost of production, and definitely in the light of those different price points, as I mentioned earlier. So here's just a little graphic. The valuations for cannabis companies do seem to be, on a bit of a downward trend here as of late. This is kind of showing the 10 largest cannabis producers in Canada, and just some of those valuations where they've gone. They spiked up in just after January there, I think, based on the fact that the US was looking at more legalization, and then when that didn't happen, the valuation kind of followed with it. Moving on to food and beverage, margins are definitely getting tighter in this industry as well. Looking at the food side, definitely as the commodity prices, drive higher and higher, that's squeezing margins for food and beverage if they can't pass those costs on to consumers. And then, of course, material prices continue to be an issue, again, largely driven by all those supply chain issues that we've talked about. So labor shortages, continue. They've been there for a while, and they don't seem to be going away. This is probably a fair comment for most of the commodities that we've talked about today, that in certain parts of the country, labor definitely is what's holding companies back from either growing or becoming more efficient. So, and definitely when we look at demand, as I mentioned, maybe in the poultry side there, we're getting back to food service, and not totally getting away from grocery, but definitely that demand is shifting back to more towards a more traditional area. So remains to be seen, obviously, where restrictions due to COVID might land up, and how long it takes for kind of consumers to shift back, and what some of the new consumer trends might actually be that come from that. So here's just a little graphic showing kind of sales forecasts that might be coming up for the food and beverage industry, and broken out kind of by sector there. So, we're seeing, I think, some positive growth for a lot of different industries, and lots of optimism going forward for most of these sectors within the food and beverage areas. So, and that's kind of the end of the presentation for this time. And I'll hand it back over to Vic.
Thank you, John, for your presentation. I just want to go over, I experienced the supply chain issues when I was recently in Phoenix. The local Fry's store, Fry's is a large supermarket down there, for those of you that hadn't heard about it before. They had to shut down their meat department for a couple of days because they couldn't get any meat. So it's affecting the big stores as well as everybody else. So these are things to watch out for. We would like to thank everyone for participating in this webinar, and would encourage you to contact John or any of our farm management consulting practitioners directly with any specific agricultural questions you may have. Any insolvency related questions should be directed to me or to any of our Cross Canada insolvency team. This webinar has been recorded and is sent to you as you had requested to be added to our ag webinar distribution list, and it will also be posted to our mmpdebt.ca website. Please feel free to forward the link to your colleagues and encourage them to contact me directly should they wish to be added to the distribution list. We look forward to your participation at our Spring 2022 webinar, and look forward to hearing from you with any questions or comments you may have. On behalf of MMP, we would like to wish all of you a very happy and safe holiday season, and here's to a great 2022. Thank you and goodbye.